Okay, we now move to this new topic. I think this is recently added and it said messages from the academic literature on risk measurement for the TRATEC book. This topic addresses tool for risk management including war and expected short form, especially if we examine war implementation over different time horizons and war adjustment for liquidity cost. The topic also examines academic studies related to integrated risk management and discusses the importance of measuring interaction among risks due to risk diversification. So value at risk implementation. Explain the following lessons on value at risk implementation: time horizon over which war is estimated, recognition of time varying volatility in war risk, and war backtesting. There is no consensus regarding the proper timing horizon for risk measurement. The appropriate time horizon depends on risk management purpose. Example, setting capital limits as well as portfolio liquidity. Thus, there is no universally accepted approach for aggregating war measures on different time horizons. Time varying volatility results from volatility fluctuation over time. The effect of time varying volatility on the accuracy of war measure decreases as time horizon increases. However, volatility generated by stochastic random jumps will reduce the accuracy of long-term war measure unless there is an adjustment made for stochastic jumps. It is important to recognize the time varying volatility in war measure, since ignoring it is likely to lead to underestimation of risk. In addition to volatility fluctuation, risk managers should also account for time varying correlation between war calculation. Simply by war estimate, the finance industry has the tendency to use short time horizon. The approach is computationally attractive for large portfolio. However, 10-day war time horizon suggested by Basel Committee is not always optimal. It is most preferred to instead allow the risk horizon to vary based on specific investment characteristics. When computing war over long time horizons, a risk manager needs to account for variation in a portfolio's composition over time. Thus, a longer than 10-day time horizon may be necessary for economic capital purposes. Historically, war backtesting has been used to validate war model. However, backtesting is not effective when war are exceptionally small. In addition, backtesting is less effective over long horizon time due to portfolio instability. War models tend to be more realistic if time varying volatility is incorporated. However, this approach tends to generate a flow cyclic war measure and produces unstable risk measure to estimate issues. So next heading is integrating liquidity risk into war models. Describe the exogenous and liquidity risk and explain how they might be integrated into war models, including the war adjustment time horizon. During the time of financial crisis, market liquidity conditions change, which changes the liquidity horizon of an investment. The time to unwind a position with materially affect its price. Two types of liquidity are there: exogenous liquidity and endogenous liquidity. Both types of liquidity are important to measure. However, academic studies suggest that this valuation model for first employed for endogenous liquidity. Endogenous liquidity is handled to calculation of liquidity adjusted war and representing a market specific average cost reduction. The LVAR incorporates a beta spread by liquidity to cost the initial estimate of war. Endogenous liquidity adjustments of price that affect for the price of effective liquidating position. It depends on the trade size and is applicable from market orders when that are large enough to move market. Endogenous liquidity is the elasticity of price to trading volumes and is more easily observed in instances of high liquidity risk. Poor market condition can cause flight to quality, which decreases the trader's ability to unwind position on thinly traded asset. Thus, endogenous liquidity risk is more applicable to exotic complex trade position, very relevant in high stress market condition. However, endogenous liquidity will be present in all market conditions. We then have the risk measures: excess war, expected shortfall, spectral, and other. Identify risk measure. War estimates the maximum loss that can occur on specified level of confidence. War is useful measure for risk since it is easy to compute and readily applicable. However, it does not consider loss beyond war confidence level. In other words, war does not consider severity of losses in the tail of the return distribution. Additional disadvantage of war is that it's not sub-additive, means war of combined portfolio can be greater than war of each of the assets within the portfolio. An alternative measure is used which is known as expected shortfall. Expected shortfall is more complex and continuous and computationally intensive than war. However, it does not correct some drawbacks of war, namely it is not able to account for magnitude of losses beyond war session. It is always sub-additive. In addition, the application of expected shortfall will mitigate the impact of specific confidence level choice that risk management decisions. Spectral risk measure generalize expression consider investment manager aversion to risk. These measures have select advantages over expected shortfall by including better smoothing process when weighting observation as well as ability to modify risk measure to reflect the investor specific risk aversion. So spectral risk measure are generalized expected shortfall, and aside from a special case of expected shortfall, other risk measures are rarely used in practice. Then we have the stress testing. Summarize the recent state of stress testing, research and practice. It is important to incorporate stress testing into risk models by selecting various stress test scenarios. Three primary applications of stress test exercise are historical scenarios, which examine previous market; predefined scenarios, which attempt to assess the impact of profit loss of adverse changes in predefined set of risk factors; mechanical search stress test, which are automated routine to cover possible changes in risk factor. In stress testing, it is important to stress the correlation matrix. However, an unreasonable assumption related to stress test is taken is that market shocks occur instantly and that rates cannot rehedge their position. In war, when war is computed and analyzed, it is generally more normalized market condition, so it may not be accurate in most stressful environment. The stressed war approach, which attempts to account for significantly financial stress period, has not been thoroughly tested and analyzed. Thus, war may lead to inaccurate risk management measures. Integrated risk management. Compare unified compartmental risk management. Unified and compartmentalized risk management methods suggest aggregate risk for banks. A compartmentalized approach sums risk separately, whereas a unified or integrated approach considers interaction among risks. A unified approach considers all risk categories simultaneously. This approach can capture possible compounding effects that are not considered while looking at individual risk measures. For example, unified approach may consider market credit operation risk altogether. When calculating capital requirements, bank use compartmentalized approach. Thereby, capital requirements are calculated on individual risks, such as market credit. Therefore, standalone capital requirements are then summed up in order to obtain bank overall capital. Basel regulation framework uses a building block approach where banks regulatory capital is sum of capital requirement for various types of risks. Pillar A risk categories include market risk, credit risk, operation risk. Pillar 2 risk, concentration risk, stresses, and other risks such as liquidity, ratio, and business. Thus, the overall Basel approach to calculate capital requirement is a non-integrated approach to risk. In contrast, integrated would look at capital requirement for various simultaneous account for potential correlation interactions. Note that simply calculating individual risk and add them together will not necessarily produce an accurate risk measure. Then we have risk aggregation. Assess the result of top-down and bottom-up risk aggregation method. Bank can be viewed as a series of sub-portfolio consist of market credit operation risk. However, these risk categories are intertwined and at times difficult to separate. For example, foreign currency loan will have both foreign exchange rate and credit risk. Thus, interaction should be considered. The top-down approach assumes that bank's portability can be clean subdivided into market operation risk. In contrast, bottom-up account for interaction among various risk factors. In order to assess which approach is more appropriate, academic studies calculate the ratio of unified to compartmentalized capital ratio. Top-down studies calculate this ratio to be less than 1, which would suggest that risk actually is present and ignored by a separate approach. Bottom-up studies often calculate this ratio to be less than 1. However, this is not conclusive and found evidence of risk compounding which produce a result greater than 1. In bottom-up studies suggest that risk diversification should be questioned. It is conservative to evaluate market risk and credit risk independently. However, most academic studies confirm that market credit risk should be looked at jointly. If a bank ignores risk independence, a bank capital requirement will be measured improperly due to presence of risk diversification. Therefore, separate measurement of market risk, credit risk most likely provides an upper bound in the integrated level. Note that if bank is unable to completely separate risk, the compartmental approach will not be conservative enough. Thus, the lack of complete separation could lead to an underestimation of risk. In this case, bank manager regulator should conclude that bank's overall capital level should be higher than the sum of calculatedly derived from risk individually. And in the balance sheet measurement, explain intermediate balance sheet measurement and the cyclic feedback loop from war constraints and leverage investor. When a balance sheet is actively managed, the amount of leverage on the balance sheet becomes pro-cyclical. This results because changes in market prices and risk forces changes in risk models and capital requirement, which requires adjustment. Now, thus capital requirements tend to amplify boom and bust cycles. Academic studies have shown that balance sheet adjustment made through active risk management affect risk premium and total market volatility. Leverage is inversely related to market value of total assets. When net worth rises, leverage decreases, and when net worth declines, leverage increases. The result is a cyclical feedback loop. Asset prices increase when asset prices are rising. The assets are sold when prices are declining. The value at risk is tied to bank level of economic capital. Giving a target ratio of war to economic capital, a war constraint or leverage investor can be established. An economic boom will relax war constraints since bank's level of equity is expanding. Thus, the expansion allows firms to make more risk and further increase debt. In contrast, an economic burst may tighten all concern for investors to reduce leverage. Thus, despite of increasing sophistication, the current regulators intend to limit risk taking have potentially to actually increase risk in financial markets. So this is again another way of thinking. Let's look at some of the questions that could come here. Which of the following is not an advantage of spectral risk measure? So spectral risk measure considers aversion to risk and offer better smoothness. Expected shortfall is a special case of special risk method. And VOR does not consider loss beyond VOR threshold. Unified approach is not used within Basel framework, so interaction among various risks is not considered. However, interaction should be considered for risk diversification. Endogenous liquidity is especially relevant for complex trading position. So endogenous and exogenous. Endogenous is like when your order is moving the market. So if you're a big investment bank or index trader, then your trade would in fact move the market. I think that was it for the topic here. Thank you for listening.